Imagine waking up one morning to find your life savings gone. Your job vanished. Your home being taken away. This wasn't a nightmare. This was September 2008, when the entire global economy stood at the edge of total collapse. And it all started with one simple lie, that housing prices would never fall. Let me take you back to 2001. America is recovering from the dot-com bubble burst and the trauma of 9/11. The Federal Reserve, led by Alan Greenspan, makes a decision. Drop interest rates to historic lows. 1% by 2003. The idea? Make borrowing cheap, get Americans spending, and restart the economy. And it worked. Too well. Meet the Johnson family, a composite of millions of real American families. Mike Johnson works at an auto parts factory. His wife, Sarah, is a part-time nurse. Combined income? About $45,000 a year. They've been renting a small apartment, dreaming of owning their own home. One day in 2004, they see a TV commercial. Own your dream home with no money down. Bad credit? No problem. They walk into a mortgage broker's office. The broker, let's call him Rick, smiles wide. He doesn't work for a bank. He's a middleman who gets paid for every loan he closes. And business is booming. Rick looks at their income and says, "I can get you into a $300,000 house." Mike hesitates. "But that's more than 6 times our annual income. The old rule was 3 times your income maximum." Rick leans back, confident. That was the old America. This is the new America. Housing prices have gone up 50% in 5 years. In 2 years, your house will be worth $400,000. You'll refinance, pull out equity, maybe buy a rental property. This isn't just a home, it's an investment. Sarah asks the crucial question, "What's the interest rate?" "Well," Rick says, "I can get you a ninja loan. No income, no job verification, no assets required. It's a subprime adjustable rate mortgage. First 2 years, just 3% interest. Your payment will be only $900 a month." It sounds perfect. They sign the papers, barely understanding the fine print that says after 2 years, their rate will adjust based on market conditions. What the Johnsons don't know is that Rick is selling them a financial time bomb. And he doesn't care, because minutes after they sign, he sells their mortgage to a big bank and collects his commission. But here's where it gets truly insane. That big bank doesn't want to hold on to the Johnsons' risky mortgage either. Let me take you to Wall Street, gleaming towers, men in $5,000 suits, traders making millions in bonuses. The big banks, Bear Stearns, Lehman Brothers, Merrill Lynch, they've figured out a brilliant scheme. Why hold on to thousands of risky mortgages when you can bundle them together and sell them? Here's how the magic works. They take the Johnsons' mortgage and combine it with thousands of others, some good, some terrible, and create something called a mortgage-backed security, or MBS. Think of it like a fruit smoothie. Blend good apples with rotten ones, and somehow Wall Street convinces everyone the whole drink is delicious. But they don't stop there. They slice these MBS into different tranches, layers of risk. The top layer gets paid first and is rated AAA, supposedly as safe as government bonds. The bottom layer? Toxic waste that will only get paid if everything goes perfectly. Now enter the ratings agencies, Moody's, Standard & Poor's, Fitch. Their job is to objectively assess how risky these securities are. But there's a massive conflict of interest. The banks pay them to rate these products. Imagine you're a teacher and students pay you for their grades. Would you give them all A's? That's exactly what happened. These agencies slapped AAA ratings on securities filled with subprime mortgages from people who could never afford to pay them back. They gave the same rating to these toxic assets as they gave to US Treasury bonds, the safest investment in the world. Why did they do it? Competition. If Moody's said no, the bank would just go to S&P. Everybody wanted a piece of the trillion-dollar pie. Wall Street sold these AAA-rated securities to everyone. pension funds for teachers and firefighters, foreign governments, insurance companies, other banks around the world. But wait, it gets worse. Some traders realized these securities were garbage. A hedge fund manager named Michael Burry spent months analyzing the actual mortgages inside these bonds. He discovered something terrifying. They were filled with loans to people with no income, no assets, houses appraised at inflated values, and adjustable rates about to explode. So Burry made a bet. He went to the big banks and said, "I want to bet against these mortgage securities. I want to buy insurance on them failing." The banks laughed at him. They created something called a credit default swap, basically insurance that pays out if these mortgage bonds fail. Burry paid small premiums, and if the housing market crashed, he'd make billions. The banks took his money happily. Housing prices never fall, they thought. This is free money. But here's the truly criminal part. The banks then started betting against the same securities they were selling to their clients. They'd sell a pension fund a AAA-rated mortgage bond, then turn around and bet it would fail. It's like a car dealer selling you a car they know has no brakes, then betting their friend that you'll crash. Goldman Sachs, the most prestigious bank on Wall Street, literally created mortgage securities designed to fail, sold them to clients, and then bet against them. When it all collapsed, they made billions while their clients lost everything. Let's return to the Johnsons. It's now 2006. Remember that 3% introductory rate? It's gone. Their mortgage rate has adjusted to 8%. Their monthly payment jumps from $900 to $2,100. They can't afford it. They call the bank to refinance. But now there's a problem. Housing prices have stopped rising. In some areas, they're falling. The bank appraises their house at $280,000, less than they owe. The bank says no to refinancing. The Johnsons face a choice: pay a mortgage they can't afford or walk away. They're not alone. Millions of American families face the exact same crisis all at once. Foreclosures begin to spike. 2007, over 2 million foreclosures. For sale signs multiply across American suburbs like a disease spreading. As millions default, those mortgage-backed securities start failing. The bottom tranches get wiped out first, then the middle tranches. Suddenly, those AAA-rated top tranches are at risk. Banks around the world start looking at their balance sheets, realizing they're holding billions in assets that are now worth, nobody knows. 20 cents on the dollar? 10 cents? Zero? In March 2008, Bear Stearns, 85 years old, one of Wall Street's most prestigious banks, collapses in 4 days. They're sold to JP Morgan for $2 a share. A year earlier, they traded at $170. The Federal Reserve has to help JP Morgan with $30 billion just to make the deal happen. This has never happened before. The fear is palpable. But Bear Stearns is just the beginning. Summer 2008, Fannie Mae and Freddie Mac, two government-sponsored enterprises that own or guarantee half of all American mortgages, are on the brink. The government takes them over in September. Cost to taxpayers? Eventually $190 billion. Then comes the earthquake. September 15, 2008. Lehman Brothers, 158 years old, surviving the Civil War, the Great Depression, World Wars, files for bankruptcy. $619 billion in assets, the largest bankruptcy in American history. The government lets them fail, thinking the market needs to learn a lesson. It's the worst decision of the crisis. The next day, panic. Pure, unadulterated panic. AIG, the world's largest insurance company, is hours from collapse. They've sold hundreds of billions in credit default swaps, those bets against mortgage securities, and now everyone's collecting. AIG doesn't have the money. If they fail, they'll take down every major bank in the world. The government bails them out. $182 billion in taxpayer money. Merrill Lynch is sold to Bank of America in an emergency weekend deal. Washington Mutual collapses, the largest bank failure in American history. The stock market is in free fall. The Dow Jones loses 778 points in a single day, the largest point drop ever. Credit freezes completely. Banks stop lending to each other because nobody knows who's about to collapse. If banks won't lend to banks, businesses can't get loans to make payroll. The entire economic system is seizing up. General Electric, one of the safest, most profitable companies in America, can't borrow money to operate. The chairman of the Federal Reserve, Ben Bernanke, tells Congress in a closed meeting, "If we don't act immediately, we will not have an economy by Monday." Congress passes TARP, the Troubled Asset Relief Program. $700 billion to bail out the banks, the largest government intervention in the economy in history. Americans are furious. Their taxes are being used to rescue the same banks that crashed the economy and paid executives million-dollar bonuses. But it gets worse. The banks that survive become even bigger. Too big to fail becomes the new rule. JP Morgan buys Bear Stearns and Washington Mutual. Bank of America gets Merrill Lynch. Wells Fargo takes Wachovia. The crisis spreads globally. Iceland's entire banking system collapses. Greece, Ireland, Spain, and Portugal face sovereign debt crises. The European Union nearly breaks apart. The human cost is staggering. 8.7 million American jobs lost. Unemployment hits 10%, the highest since the early 1980s. 10 million people lose their homes to foreclosure. $19.2 trillion in household wealth evaporates. Retirement accounts cut in half. Millions lose health insurance. The Johnsons? Mike loses his factory job when the auto industry collapses. Sarah picks up extra shifts, but it's not enough. They walk away from their home in 2009. Their credit is destroyed for 7 years. They move in with Sarah's parents with their 2 kids. They did everything they were told to do, pursue the American dream, and the system destroyed them. Now here's the most infuriating part. What happened to the people responsible? The CEOs, the traders, the mortgage brokers, the ratings agencies' executives. Did they go to jail? Did they lose everything like the families they destroyed? No. Exactly one person went to jail. A mid-level Credit Suisse banker for hiding losses. The executives? They walked away with millions. Dick Fuld, CEO of Lehman Brothers, made $466 million in bonuses before the collapse. He kept most of it. Angelo Mozillo, CEO of Countrywide Financial, the largest subprime lender, made $470 million. He paid a fine of $67.5 million and settled without admitting wrongdoing. The traders who created and sold toxic securities? Most moved to other banks, some started hedge funds. Lloyd Blankfein, CEO of Goldman Sachs during the crisis, told the Times of London that bankers were doing God's work. His 2007 bonus? $68 million. Meanwhile, millions of ordinary people lost everything and were blamed for living beyond their means. So what did we learn from the worst economic crisis since the Great Depression? In 2010, Congress passed Dodd-Frank, the most comprehensive financial reform since the 1930s. It created new oversight, restricted risky trading, and required banks to hold more capital. But here's the uncomfortable truth. Many of those regulations have been rolled back. The banking lobby spent billions on political donations and lobbying. By 2018, significant portions of Dodd-Frank were gutted. The banks that were too big to fail in 2008, they're even bigger now. The top 4 U.S. banks, JP Morgan, Bank of America, Wells Fargo, and Citigroup, now hold more assets than they did before the crisis. We bailed them out and they got bigger. We asked for accountability and we got excuses. We wanted reform and we got business as usual. But here's what's truly important to understand. This wasn't a natural disaster. This wasn't a meteor strike or an unavoidable economic cycle. The 2008 financial crisis was a crime. It was fraud dressed up in mathematical formulas. It was greed disguised as innovation. It was a con job perpetrated by the most educated, sophisticated financial minds in the world who knew exactly what they were doing. They created a system where profits were privatized and losses were socialized, where bankers got rich and taxpayers picked up the tab, where the people who destroyed the economy faced no consequences while the victims were blamed. And the scariest part? It could happen again. The fundamental incentive structures haven't changed. Bankers still get massive bonuses for short-term profits, even if they blow up their companies later. Ratings agencies are still paid by the people they're rating. Too big to fail, banks are still too big. We have short memories. The pain of 2008 fades. New generations enter the markets. And slowly, the same risky behaviors creep back in. Different instruments, same greed. The 2008 financial crisis taught us something profound about human nature and systemic risk. When you create a system that rewards excessive risk-taking and shields people from the consequences of their actions, they will push that system to the breaking point. The question isn't whether another crisis will come. The question is whether we'll have learned enough to prevent it from being as devastating, and whether we'll finally hold the people responsible accountable. Because until we do, we're just waiting for the next bomb to go off. The Johnsons? They're still recovering. 16 years later, they're renting again, rebuilding their savings dollar by dollar. Their kids grew up understanding that the American dream isn't guaranteed. It's fragile, and it can be stolen by people who face no consequences. That's the legacy of 2008. Not just a financial crisis, but a crisis of trust, justice, and accountability that still echoes today. And that's a story worth remembering.